Peter Lynch is a legend in the investing world. He managed a mutual fund, the Magdalene Fund, for almost 15 years, where he had an annual return of 29%, which beats Buffett by about 9%. Buffett averaged around 20%. As his fund grew, he went from owning 60 stocks to 1,400. So he is somebody I would like to read a book from, and I decided to pick up Beating the Street by Peter Lynch. In this book, he talks about how to devise a mutual fund strategy. He has 3 chapters dedicated to how he managed the Magdalene Fund, and there are about 13 chapters about the way he chose the 21 stocks he recommended in 1992 in the Barron's Journal. So I have read this book, and I will break down my favorite 11 laws that Peter Lynch gives in Beating the Street. I have 11 laws, and I have saved the best ones, in my opinion, for the last. So the first one that I have outlined is retail store is your best friend. Peter explains how one of the ways he chooses his next stock is simply by going to the mall. By seeing which stores are upcoming and booming is one of the many ways he can predict a new upcoming hot stock. On the other side, it is also easy to see which stores are not doing so well either. So the best way to see how business is doing is to see it for yourself. The next law that I have outlined is that Peter says that stocks over bonds, always. Peter represents his love for stocks numerous times. To anyone reading, it is really clear that if Peter Lynch had to choose between stocks and bonds, his choice would lie among stocks. The reason he advises stocks over bonds is because he outlines that you could get a bigger reward from stocks than you can from bonds. Companies reward their stock owners way more than they reward their bond owners. In the end, you only need to select a handful of high-quality stocks after thoughtful research to be successful. He's also not saying that you should not invest in bonds, but he's saying that the money lies in stocks. Number 9, I have outlined that you should look for great companies in lousy industries. So strong performance attracts competition. So when an industry is doing well, then everybody is trying to get into that game. Meanwhile, for worse industries, it's the opposite. People are trying to pull out of the game. So Peter Lynch advises to buy stocks in companies that are doing well in lousy industries. This is because these businesses, they're doing well in bad industries, and as everybody leaves, they get a bigger market share, and profitability will rise as competitors lose ground. It won't be long until the stock price rises as well. He advises to look into the less popular industries, but with good companies in them. For number 8, I have selected stock picking is not a formula. The author explains that stock picking is not a formula. Instead, it is a mix of art as well as science. Whatever worked for somebody else may not work for you. However, the author advises the following. If you study 10 companies, you will find one for which the story is better than expected. If you study 50 companies, you will find 5. There are always pleasant surprises to be found in the stock market, companies whose achievements have been overlooked on Wall Street, etc. The author mentions it many different ways, however, the message is always the same. Do your research when investing into stocks and know what you can own. For number 7, this is obvious, but nevertheless very important. Never invest in a company without understanding its finances. Kind of evident, however, for some people they still miss this point. Peter explains how the largest stock losses occur in businesses with weak financial sheets. So he advises to always check the balance sheets to determine a company's financial stability before investing your money in it. Don't just pick a stock because it's in the news, because everybody's investing into it. You need to understand for yourself where the finances are and how they're being worked with. That way, you are less likely to invest in the wrong company. For number 6, we have go where other investors and fund managers fear to tread. In every industry and every region of the country, the observant amateur can find great growth companies long before the professionals have discovered them. Therefore, it's important to understand that just because the professional investors and fund managers are not making moves in a certain stock does not mean it's not worth investing into. In the stock market, it's very important to understand that it pays to be a contrarian. Down to the top 5 laws. Number 5, we have focus on the company, not the stock. If I could summarize the book into one sentence, this would be it. Peter Lynch heavily puts emphasis on researching the company, researching everything about the company before you invest into it. Behind every single stock lies a company. You need to understand what the company does and how they do it. The stock price and performance is a direct reflection of the business itself. Therefore, focusing on the business itself instead of the stock can help you make a more accurate decision. Peter Lynch says that often there is no correlation between the success of a company's operation and the success of its stock over a few months or even a few years. However, there is 100% correlation between the success of the company and its stock in the long term. For number 4, I decided to include this because I feel like a lot of people always forget this. The stock market declines are normal. The author explains that keeping away from stocks because of crashes also keeps you away from a large amount of gain. Stock market's decline are routine activity. You can lose money in a very short time. However, it's important to remember that it takes a long time to make money in the stock market. Over the course of a 70-year period, the market has declined 40 times. So as an investor, you have to be willing to be in the market for a long term. The third best law in this book would be the best stock to buy might be the one you already own. So if you're looking for deals but you aren't finding any, consider increasing the position of one of your own stocks. There is no need to take a chance on a riskier company just to get a new name in your portfolio. The second best law is only invest into what you can handle. A lot of people put a lot of companies on their plate and they cannot manage them. As outlined many times, it is absolutely vital to stay informed on the companies you have chosen to invest into. Therefore, Peter Lynch advises to only invest into the number of companies for which you can keep track of. Quoted from the book itself, "Owning stocks is like having children. Don't get involved with more than you can handle." The part-time stock picker probably has time to follow 8 to 12 companies and to buy and sell shares as a conditions warrant. There doesn't have to be more than 5 companies in the portfolio at any one time. It's important to remember, a little goes a long way. If you invest in 12 mediocre companies, that's going to do you worse than investing in 3 good companies. Make sure that you could handle keeping up with all the stocks in your portfolio, therefore you have less room to make mistakes. My favorite law in Beating the Street by Peter Lynch has to be, anyone can invest into stocks. Many people keep away from the stock market because whether it is intimidating, whether they believe that they cannot learn, for whatever reason, they're keeping themselves away from massive gains. The author heavily puts emphasis on the fact that it is vital to do your own research pertaining to stocks. Your financial literacy is in your own hands, and if you want to succeed, it is up to you. A lot of people make the stock market very intimidating because they want to keep you out of it. Your financial literacy is in your hands, and if you want to learn, it is completely up to you. Don't keep the gains away from you. Thank you, everyone. This is Paradolia.